So since 2018, a lot of you generous people out there have not been getting a tax break for your charitable giving. So today, I'm going to give you 3 main strategies to use the tax code to your advantage to get that tax break back. And I'll also give you a bonus tip to really supercharge your charitable giving. And don't get me wrong, I know that giving shouldn't be about the tax break, and it's not. But if we can save you taxes by not changing how much you give at all, I think that makes a lot of sense for you. So let's jump right in. All right, so here are the 3 ways that you can make your giving a little more tax efficient. So the first one is batching. Now, since 2018, the standard deduction went up. And what that means is that it is harder to have any itemized deductions, which is where your charitable giving falls. It's harder to get credit for that. Now, the last couple of years, they've allowed $300 or $600 in charitable giving to be deducted without having to use the itemized deductions. But I'm not talking about that. I'm talking about those of you that are giving a large amount. I actually had a client recently who has been giving over $1,000 a month since 2018, over 10% of their income, and have not got a tax break for it at all. And there was a couple simple strategies they could have used. This is one of them. So batching, let's talk about it. So the standard deduction for a married couple filing jointly that's not over 65 is $27,700 in 2023. So that's the hurdle all of our itemized deductions would need to break in order to get any credit for our deductions. So itemized deductions, here's just some examples of what I see a lot on tax returns for those near or in retirement. They might have a state and local taxes, SALT taxes. Those are capped at $10,000. So I'm putting $10,000. You can deduct that. And then mortgage interest, let's say that's $7,700. And then the one we're talking about today is gifts to charity. So in this case, just for easy math, I wanted to add those up to $27,700. So right here, if this couple gave $10,000, they would not actually be getting any tax credit because the $27,700 equals the standard deduction. So what I want to talk about is batching. So batching would be giving this $10,000. What if we strategically gave that in 4 years? So down here, this is 4 tax years, and what I want to show is what if you batched 2 years worth of charitable giving into a single year? You know, what if in January you gave $10,000 and then in December you gave $10,000? Well, in that case, instead of having the standard deduction of about $28,000 a year for the 4 years, in year 1 you might have $38,000 in deductions because you gave $20,000 technically, but it covered year 1 and year 2. So then in year 2, you just take the standard deduction. Okay, you didn't technically give to charity in year 2. You front loaded it in December of year 1. Okay, and then in year 2, you give nothing, but year 3, you do it again. You batch, you give 2 years worth, and now you have given the same amount. You have given $40,000 over the 4 years, the same amount you would have, but let's see what it looks like comparatively. So the year 1 through 4 summary, normal amount given is $40,000. By batching, it's still $40,000. That has not changed. You didn't give any more to get a tax break. Deductions, though, when you take that $27,700 times 4, it's $110,800. By batching, now you've gotten deductions of $130,800, $20,000 extra in deductions. So the taxes saved, in quotation marks there, $20,000 times, I'm saying the 22% tax bracket is $4,400 over those 4 years. Now, is that a big amount? No, it's not huge. That's not going to change your life at all, but it's also 10% of your charitable giving over that 4 years. So if I told you that, hey, you can get let's say a 10% match, if I reframe that and say you can get a 10, 11% match on your charitable giving, you'd probably take that, right? So that is what batching is all about. Let's move on to number 2. So number 2 is a donor advised fund, and this is really like a supercharged version of batching. So let's come over here. So a donor advised fund, let's say your annual giving is $10,000 and we know that we're going to do that. And so a donor advised fund allows you to contribute an amount to it. And when you contribute, the year that you contribute, you get a tax deduction. You get to itemize that deduction. So let's say you gave $100,000 to a donor advised fund. It goes into this fund and now it can continue to grow. It can be invested, it can grow, and then you can tell the donor advised fund where you would like certain distributions each year to go. Now, I put an asterisk because there's rules. You'll have to look into that. But for the most part, if it's a qualified charity, you're going to be fine there. So, an example, you give $100,000 to a donor advised fund. The donor advised fund distributes $10,000 to charity of your choice in year 1. Year 2, you had $90,000 left, $100,000 minus 10. $90,000 though, it was invested, so it grew to $95,000 and it distributes $10,000. So the great thing about a donor advised fund is it allows your money to continue to grow. So a lot of times when you're doing this, you're pulling money out of investments, and if you were to just give all of that up front, you're not really going to like that because you're giving up the compound interest effect. But with a donor advised fund, you don't have to give that up, and you're getting a tax break all at once. So let's give an example of this. Let's say that your income normally looks like this. Okay, this is what a normal income year might look like. That's year 1, that's year 2. But then year 3, for whatever reason, you have a super high income year. Okay, maybe that's the year you retire and you get a big payout. They give you a big severance, or they give you 2-3 years worth of salary to retire early. I see that all the time. So that's year 3. Well, if this takes you up into some higher tax brackets and you know that you give $10,000 a year and you have plenty of investments and you're going to be fine to go ahead and give that $100,000 to the donor advised fund, well, that's where it makes a lot of sense, because you can give whatever amount. I'm saying $100,000. You can give that $100,000 and it will lower your taxable income, hopefully get you back down to the brackets that you will be in for the foreseeable future. So, donor advised funds, I really like utilizing them when you have an abnormally high income year. You can also pair this with Roth conversions. You can pair it with other strategies, but donor advised fund, great way to get credit for your charitable giving. Now, keep in mind, you do have to be super sure that you want to give this money, because once you give it to the donor advised fund, it's not yours. You can't get it back. It's not like you can change your mind. You just get to direct when and where the distributions go. Once again, with caveats, asterisk upon asterisk. All right, let's look at the third method before we get to the bonus tip on how you can supercharge those first two. So the third one, pretty simple: qualified charitable distributions, otherwise known as QCDs. Now, you have to be age 70 and a half. Last week we talked about one mistake I see with Roth conversions is people converting all of their traditional IRAs, and QCDs is one reason, because they allow you at age 70 and a half to give directly to a charity up to $100,000 a year, and it will not show up on your tax return, and you do not have to itemize. Okay, that's the important aspect. Do not have to itemize. Now, here's the trick with qualified charitable distributions. This is how you would normally do a charitable distributions, right? You're taking distributions from your IRA as income, and then it goes into your bank account, and then you give to charity. This is wrong. You cannot do this. If you do that, it's taxable. Your $10,000 is taxable right there, and then when you give it, yeah, you might be able to itemize it, but as we saw earlier, it's tougher and tougher to itemize. So in order to make this work, I'm going to go back to black here. In order to make this work, you have to have the IRA send the 10K straight to the charity. Okay, and that's a qualified charitable distribution. So then, let's say throughout the year you have IRA distributions of 100K. That's what your tax form from your custodian is going to say. Well, on your tax return, you are only going to show taxable distribution of 90K. All right, so you don't itemize it, you just simply don't report it. And this is tricky because your tax form is not going to say that you did a QCD. So you need to keep track of that. You need to give documentation to your CPA, and then you need to check and make sure that your accountant gave you credit for the QCD and didn't count it as taxable income. Okay, so those are the three main ways that you can get tax credit for your charitable giving without changing the amount that you're giving. Now, the bonus tip is to donate appreciated stock. Now, this only applies to the first two. It doesn't apply to the QCD, but donating appreciated stock supercharges your giving because you're wiping out some capital gains. So what am I talking about there? So let's say you own ABC stock and you've owned it for a long time. You bought it for $10,000 long time ago, and now it's 10x in value. It's worth $100,000. If you were to sell that stock right now, it would be a $90,000 capital gain, which is either going to be taxed at 15% at the federal level or 20, 23 even. So what I want you to do is, instead of giving cash to charity, instead of batching by giving cash, or instead of giving cash into a donor advised fund, if you have taxable investments, a taxable brokerage account with highly appreciated stock, I want you to gift the stock directly to the charity or the donor advised fund. Now you get the deduction plus you avoid the capital gain. Now, do not give stock that is at a loss. All right, if you give that, then you're giving up a tax break. So in that case, I'd rather you give cash if that's all you have. But if you have highly appreciated stock, give that instead, and you will get a nice little tax bump. So let's go into this a little bit further, and let's assume you're in the 22% tax bracket, and your options are you're either going to sell the stock to give cash to the donor advised fund or to the charity, or you're just going to gift the stock directly. So if you sell the stock to give cash, you're going to have a $90,000 capital gain right there. And if you take 90,000 times 15%, that equals $13,500 in taxes that you'll pay. Now, when you give the 100,000 though, you're going to have a deduction of 22%, or you're going to reduce your taxes by 22% on that deduction. So that's 22,000. The net tax savings of your $100,000 donation, that whole transaction combined, is $8,500. Now, gifting stock directly, if you just give the donor advised fund or give the charity the $100,000 in stock directly, you don't have a capital gain. So you get rid of that part of the equation. You just don't have this aspect of it. You only have the $22,000 tax savings, which saves you a difference of $13,500, the capital gain. Now, this is assuming that you are going to sell the stock at some point, either now or in the future. And, once again, caveat on top of caveat, because I don't necessarily want taxes to drive your investment behavior, but this is a case where, if that was part of your plan, if getting rid of some of that stock was part of the plan, then this is a no-brainer in this case. Charitable giving is just one layer of tax planning, and we can layer on top Roth conversions, capital gains planning, distribution plans. All of that has to be layered in to this plan. But I think if you're going to be generous and give to charity, especially if you're giving a significant amount, then I think you should be rewarded by using the tax code to your advantage. Now, if you enjoyed this video, share this with a friend if you think they might benefit from it. And some of this might have seemed like obvious stuff, but to someone else, it might be the first time they're hearing of it. So do them a favor, do me a favor, and share it with a friend. Until next time, have a great rest of your day.